So you want to learn supply and demand trading, but you don't know where to start. In this video, I've put together the most clear and concise full A to C guide to supply and demand trading, everything that I've been testing and trading over the past 3 years, back testing, live trading, and putting this all into practice. So if any of that sounds interesting to you guys, make sure to stick around until the end of the video. I'm going to be going through the full A to C of supply and demand trading. So whether you're a beginner and you want to learn the very basics, or you're already an advanced trader and want to improve some more, make sure to stick around to see the full guide, and I'm sure it will bring you some sort of value. Alright guys, so welcome to the video, welcome to this free course. So getting straight into it, these are the things that I'm going to cover in this whole course, and it's basically the entire strategy which I've been implementing for the past 2 or 3 years in the market. So first of all, we're going to go through how to actually identify market structure, supply and demand areas of liquidity and the types of liquidity that I look out for, the entry model that I use, how to actually go about forming a risk management plan, and how to calculate the correct lot sizes per trade. And also at the end, I'm going to go through some examples to make this super concrete and super clear for you guys. So jumping straight into it, we'll go straight first into what market structure actually is and how I personally identify it. So I've drawn on here a diagram of how I personally see the market and how I draw on the market structure levels, so the swing highs and the swing lows. So what we've got here is an uptrend, and we can see that price is forming higher lows and higher highs. So simply all I do is I identify and draw on the main breaks of structure, and also, so the main breaks of structure. So in this case, we are viewing price like this. So a break of structure is after a pullback in price will then push up and break the high. I would consider that a break of structure. So when we have this impulse leg, we then get a correction. If price makes another impulse leg breaking the high to the left, I would consider that a break of structure. And here we have a few more examples of that drawn on. And I get asked this question a lot. People always ask me, what is the difference between a break of structure and a change of character? Basically, a change of character is the same thing. It's just a break of structure in the opposite direction to the trend. So in this instance, you can see that we were in an uptrend, but then price broke the most recent higher low, forming a lower low, and this would be considered the change of character. So basically, to summarize that, in an uptrend, price breaks the most recent higher low, forming a lower low, and that is our change of character. One thing also to note about market structure is that it is fractal in nature, which means that this same structure could be on the higher time frame or the lower time frame. And within each one of these legs, we have lower time frame uptrends and downtrends with the same structure as this, so forming higher lows, higher highs, and lower lows and lower highs on the lower time frame. So to make this a little bit more clear, if we go to the charts and actually draw on some of these levels. So if we go over to GBPUSD, which is a little bit more clear than gold, and we will go over to we go to here. So this is going to be an example of market structure in a downtrend. And in this case, we're on the 1 hour, but like I said, market structure is fractal. So this same structure applies on the lower time frames and also the higher time frames. So in this case, we can see that we've had a retracement here. Price then pushed down, taken out the low, which initiated the pullback. So this would be a break of structure. And for simplicity, I just mark this as a B on my charts. We then had another retracement, and then once price took out the low, which initiated that retracement, this would be another break of structure just there. We then had another retracement, price pushes down, and then takes out the low which initiated the retracement. So this is another break. And also the same thing here. So we had a pullback, price pushes down, taking out the low which initiated that retracement as well, forming a lower low, like we can see just here. So this is basically the simplest way of drawing on market structure, and it's how I personally do it. This basically just forms the basis of the strategy which I'm going to outline for you guys. For a lot of you, this will be just a recap of what you already know. However, it is very important that you, if you are new to trading, you get familiar with this way of identifying structure, as it is one of the fundamental parts of the strategy and is essential that you can do this in order to operate the strategy well. So we mentioned breaks of structure in that example, but what about a change of character? So if we can go back over to the chart and see if we can identify that now. So let's go on the higher time frame for this, and we'll go over to here. So in this case, if we draw on the market structure once again, so here we've had a 4-hour break of structure because price did a retracement and then it pushed up, taking out the high to the left. We then had the initiation of a retracement. Price then pushes up, taking out the high to the left, forming another higher high. That is another break of structure. But what happens at this point is more interesting, because we have a higher high created, but then what price actually does, if we remember the diagram, price breaks past the most recent higher low. So in this case, the higher low is this zone just here, and price then breaks the area. In fact, this was a wick below, so I wouldn't consider that a break of structure. I would consider the change of character when this price action here occurred, because price actually closed below the structure. In cases like this, where price just wicks below it, it could just be a liquidity sweep for price to continue higher. So in order for a valid change of character, I need to see a closure, a candle closure below this zone, as price did just here. So that is our change of character, which I also mark on the charts with a C, just for simplicity. So yeah, that is a basic overview of how I identify and view the market. As I said, a lot of this will be recap for you guys. But for anybody new, this is just how I identify market structure and how I personally view the market. So if we go over to step 2 now, which is the areas of liquidity and the main types of liquidity that I use. So for anyone unfamiliar with the concept of liquidity, I've given a basic definition of it. So in the most simplistic terms, an area of liquidity is an area in the market where people were previously buying or selling, which means that there is an accumulation of orders and stop losses within these regions. So for example, if we go back to here, an area of liquidity in the market would be this whole sort of support that price has formed just here, because we have seen evidence in the chart that people were buying in this level multiple different times. So we know that there are stop losses and also orders resting below this area just here. And what this basically means, or so the theory goes, is that price is likely going to target this area of liquidity, simply because price needs to sweep some liquidity in order to move, and it needs to collect that. You can think of it as money from where people were previously buying or selling. Price likes to target these people and take them out before moving in the opposite direction. So you can see, for example, in this case, we had these two lows just here. Once price swept those lows out of the market, taking the liquidity, it moves in the opposite direction like this. So that is basically the basic theory behind liquidity, which I know is already familiar to you guys. So onto the types of liquidity that I personally use, and of these I have 4 main types that I use, starting off with the Asian range. So the Asian range is basically the range that accumulates during the Asian session, which in the UK is between 11 p.m. and 6 a.m. Plus or minus a few hours. Plus or minus a few hours. And basically what happens in Asia session is price normally begins to consolidate, and it will be very corrective in nature, particularly on pound and US dollar pairs. So let's get an example of this. So let's go to this level right here. One easy way to identify the Asia range as well is in indicators we can type in Asian range, and this one by Nico948 is the best one. In my opinion, is the one I personally use, and this grey box is basically just the Asian range, the high, the low, where it starts and where it finishes. And as you guys can see, a lot of the times we have this sort of consolidation within Asia session where price is very corrective in nature and just moving sideways. I'm not going to go into how I use this at the moment. We're just going to simply identify the areas of liquidity and what they look like, and we can get into later how we actually apply these in the market and use them in the strategy, which I'm going to go through. So the next type is equal highs and lows, which is probably one of the easiest areas of liquidity to identify and is one that a lot of people use. So if we go back to here once again, so using the same example as before, just over here. So in this case, we can see that we had, if we draw a line, multiple areas, multiple touches of this area. So we have multiple different equal lows in this particular area. And then as you can see, price comes down at a later date, sweeps that previous area of liquidity, and then gives a reaction to the upside. So very simply, equal highs and lows is literally what it says in the name. We have an area where there are multiple different lows where people were previously buying. And as for equal highs, if we try and find an example of that. So if we look just here, we can see that within this area, we had an area of equal highs just here, where we had 1, 2, 3, 4 taps of this one area. Price then comes above it, and that is when we get the reaction to the downside, because price was gravitating towards the orders that were above this level, and once they were swept, price has no reason to hang around anymore, and it drops, taking out opposing liquidity. So the next type is trend lines. So this is very similar to the equal highs and equal lows, but very simply, when we have an area such as this, where we have a trend line, price will very often wick above the trend line like this, sweeping liquidity from that trend line, and then moving in the opposite direction. Same theory as before. We know that if we can see this trend line like this, lots of other people are also seeing this trend line. Therefore, people are selling from this trend line, and there are orders resting above it and also below it. So price then wicks above, taking that money from the previous people selling, and then moves in the opposite direction. If we also try and find a bullish example of this, so you could say this was one as well, where you can see price has formed this trend line. At a later date, it then comes down, sweeps the trend line, also sweeping these two equal lows into an area below, and then moves in the opposite direction after having swept those previous buyers out of the market. The last type is a bit more of an esoteric type of liquidity, which I see fewer people using, and it is this idea of an inducement, which, if we go over the definition first of all, is when price narrowly misses an area of supply or demand, and then price will then at a later date come back into that area, sweeping the inducement above or below it. So for example, let's go ahead and show what I mean by this. So if we go back to recent price action, so let's say we had this area. Actually, that's a bad example. Let's go for another example. I think there was one recently. Let me just try and find an example for you guys. Okay, so this is quite a good example. So, okay, so here we have an area of supply, sorry, an area of demand. And in a moment, I'm going to go through exactly what I mean by an area of demand. But for now, just bear with me. And what I mean by an inducement is when we have a situation like this, where price, if we mark this on. So an area of inducement was this wick just here, because it came very close to tapping into the demand, but it didn't quite touch it. As you can see, the demand was left unmitigated, meaning it was left imbalanced, with this imbalance just here to the left. And then at a later date, price pulls back into this zone, sweeping the inducement low, and then we get that reaction over to the upside. Similarly, there was an example here as well. If we play price on a little bit. So once again, after we tap the area of demand, we can see that price moved over to the upside, and we can also draw on a change of character just here. Once again, going back to the idea of market structure, we had this series of lower lows and lower highs. Once price came into the demand, that sequence ended and price broke the structure, forming a higher high. It then pulled back. But what we can see here is we have an inducement, because you can see very clearly this area of 15-minute demand within here. We have multiple different lows above that area, but it didn't quite touch the zone. And then watch what happens once price comes back and sweeps all of these lows resting above the demand. So eventually price comes into that zone, and that is exactly where price flips back bullish, and we get this move over to the upside. Once again, price formed all of these lows above the area of demand, but didn't quite touch it. Therefore, these lows were said to be inducing the area of demand. So that is basically all of the types of liquidity that I personally use, and these are going to be very important later on when we go through how we actually enter and look for valid levels to enter from. So going over to step 3, we have how I actually identify these supply/demand levels. So as a basic definition, an area of supply or demand is an area where a large amount of volume came into the market previously. And the theory is that because a large amount of volume came into the market previously from this level, when price returns to this level, we will also see an equal or slightly less voluminous reaction from that zone. So for example, in this case, we can see that once price came into this region before, we had this massive push away. Price then came back, and once again we had that push away with a lot of momentum coming into the market. So this was said to be an area of demand. An area of supply, if we go through an example of that now, would be this area just here. As we can see, once price made this move up, a lot of volume came into the market and we got this imbalanced push down. When price returned into this area, sweeping some liquidity to the left, it then again pushed away from that area with a lot of momentum. This was an area of supply. Sorry about that. Another good example was here. We had this area where price clearly pushed away from with a lot of momentum. Once it then came back into this zone, what did it do? It reacted once again and pushed away from that zone. So to clarify this further, what is the criteria that we need to see for a valid area of supply or demand? So first of all, basically we're going to identify an area where we're looking to enter a buy or a sell position from on the 4 hour or the 1 hour, so on the higher time frames. And this is basically just because higher time frames carry more weight. There's more liquidity within that 1 hour or 4 hour candle than there is on, say, the 1 minute, and therefore price is more likely to respect them. They are said to be higher probability zones. And the three main criteria that I have given for an area of supply or demand to be valid is that it must create imbalance. So if we go through an example as I say this, so in this case we had this area of supply, and the reason that this was an area of supply is because it created imbalance. It must have one of the 4 types of liquidity below it. In this case, we can see we had this inducement, and it must be within the current leg of the trend. So in this example, how we would have drawn on the trend would have been, so we had a break of structure just here. And then moving further down, we also had a break of structure just here. That's a break of structure. It's quite hard to see, but it is one because we had a pullback, a push down, breaking the most recent low and forming a lower low. So this would basically mean that the current leg of the trend is between the high and the low. We don't want to be looking for sells if price comes above this area, because then we would have considered that to be a change of character for buys. We would consider it to basically be a trend change, and then we would no longer be looking for some sells. So that is the third criteria, must be within the current leg of the trend. To clarify that point further as well, what this basically means is that, let's say price is in an uptrend here. What we're not looking to do, say price is at this point in time. So looking at this trend here, the current trend leg is between this low and this high. So what we're not looking to do is look to buy from an area of demand, say like all the way down here, because it is outside of the current leg of the trend. So that's what we mean. We're looking to identify the range between the low and the high, and then we're only looking for areas of supply or demand within that range. And I just went through the example. So once again, let's go for a few more examples just to make this concrete clear. So in this case, we had, let's go to here actually. Okay, so in this case, we can see that price broke structure. So to identify our areas of demand that we're looking to buy from, we look at we first of all identify the current leg of the trend, which is in this case between this low and this high. Going back to this point. So between this low and this high is where we're looking for an area of demand. And in this case, we can see that this candle just here created imbalance. It broke structure to the left, and as price came towards it, it also started to generate some inducement above it as well. As we can see, price created these lows. So what we're anticipating is for price to sweep those lows into the demand and then give a reaction as it did. One thing I also want to mention as well about the supply and demand areas, how I'm drawing these on is I'm basically taking for a buy example, so for an area of demand, I'm taking the candle which created the imbalance, which created the imbalance, and I'm drawing the box between the top wick and the bottom wick, just like that. And then for us, a sell example, I'm doing the same but in reverse. So if we get a good example of that. So here, for example, looking at this trend, we can mark on this break of structure. So to identify an area of supply, we identify the current range between the high and the low. And in this case, we can very clearly see this area of supply just here, which is an area of supply because it created imbalance. It's within the current leg of the trend. It also led to this break of structure. And once again, I'm drawing this box between the bottom wick and the top wick of the candle, which caused the imbalance. And if we have a look, that is where price taps back into, and we get a reaction from that zone. You can also see that price induced the level with this wick here. This was an inducement because price pushed away before it got to that level, and then later came back, swept the sellers below the level, and then it continued to sell off. We also had that wick just there, which was also an example of some liquidity. So that is basically how I identify the supply and demand levels. I would recommend that you go on the chart and try and identify some of these for yourself, just to cement this in your mind and get familiar with how we are identifying these areas, as they are also a fundamental part of the strategy, and it is essential that you can identify and draw these on before we go further into this. So now that we've discussed market structure, liquidity, and how we actually draw on the areas of supply and demand, and how we actually look for trades, so how we're going to be looking for a particular zone to buy or sell from, we want to ask ourselves, how do we actually enter once price comes into that zone? So if price, say, comes to an area of demand, how do we enter from that demand zone? Because obviously we don't just want to buy as soon as price comes into that zone. We want a little bit more confirmation and confidence that price is going to move away from this zone and not just, blast straight through it. We want some confirmation that this zone is going to hold and price is going to move away from the zone. This is where the lower time frame entry model comes into play, and I've simplified this as much as possible for you guys to make it super clear, and this is what I found to work best over a large sample size in my back testing. So basically, once price is in the area of supply or demand, we go over to the lower time frame. So if we go through an example as I talk through this. So let's go through this recent example from last week. So remember, in this case, we were looking at this trend where we've had hourly break of structure just here. Like that. This was the area of demand that we had identified for a potential buy position, but we don't just want to set a limit on this area. What we want to be doing is waiting for price to come into this level, and then we want to see some sort of confirmation that price is going to move away from this level, and basically our analysis is correct. So for this, once price is in the zone, we go over to the lower time frame, and the time frame we go to depends on the time frame which we identified the area of demand on. So if we identified the demand on the 4 hour, we go over to the 15 minute. And if we identified the demand on the 1 hour, we go over to the 5 minute. And then on this lower time frame, we have to mark on the current structure as we previously did on the higher time frame. So what this basically means is we're going to mark on the lower lows and lower highs. So if we go ahead and do that on the chart. So as you can see, price has tapped into our area of demand, and on the 5 minute price is currently bearish because it is forming lower lows and lower highs. Again, this is because of the fractal nature of the market, like I previously discussed in the first slide. So even though this move down is likely a higher time frame pullback for more buys, at the moment 5 minute is bearish, so we want to be waiting for this to flip bullish. So marking on the most recent structure, we've had this as a break of structure because price pulled back. We then had that push down, breaking past the low, forming a lower low. And then once again, just here, we had a pullback, price then pushed down, breaking the low. And once again, price pulled back, pushed down, and broke this low just here. However, what we can see now is quite interesting because price has broken out of this downtrend. We can see that once it came into our area of demand, which is this white box, price then pushed up, breaking the most recent structure, which is the next step of the entry model. So now once we've identified the structure on the 5-minute, we wait for price to close above the most recent structure. In this case, this was the most recent structure. Price has clearly closed above it with all of this momentum as well. So we can identify that and draw it on as a change of character. Once again, marking that with a C. And we'll get rid of some of these as well. So price broke structure with imbalance, which is the next sort of criteria, that it must create imbalance. If this had broken structure but didn't create any imbalance, I would not consider that valid and I wouldn't look for an entry. Set a limit on the area of demand that price created after the break. So in this case, I did say that we are looking for the entry on the 5-minute. However, in order to see the area of demand to enter from more clearly, I'm going to just go over to the higher time frame so that we can see that the whole area of demand that we're looking at is this zone just here. But going back on the 5-minute to make it super clear, this is the area of demand that we want to be entering from. And since we have our confirmation, price came into the demand to the left, we had the lower time breaker structure with imbalance, we can now just set a limit on this zone just here. And as for targets, I didn't add in a target, but what we can say is if you guys are new to this strategy, what I would highly recommend is making the target or the take profit as mechanical as possible. So what we're going to do in this video is just go for a set 1 to 3 risk to reward. This is based on the win rate of the strategy. So personally, in the live market, my win rate is between 40 and 45%. So obviously with a 1 to 3 risk to reward, let's say over a sample of 100 trades, I win 40 of those, lose 60 of those, and with a 1 to 3 risk to reward, risking 1% per trade, the total profit is expected to be minus 60 plus 120, so 60%. So obviously we are profitable with a 1 to 3. So yeah, we're gonna target a mechanical 1 to 3. So around this area just here, and then we can see, we obviously know this trade plays out because it's one I took live. But there we go. You can see that price fell to break through this area of demand and respected it multiple different times. So yeah, that's the first example I wanted to go through. If we go through another example now, and this time we'll look for a sell position. And the last sell position I took was this one just here. So let's go through this step by step. Once again, we're identifying the structure. So in this case, the most recent break of structure was just here. This means that now we identify the current range that we're looking for some sells, since price is bearish. And the current range is clearly between the high and the low. So within this range just here, we are looking for an area of supply to sell from. And also remember as well, if we go back to here, it must have some liquidity below the area, and it must be within the current leg of the trend. It must also create some imbalance. And this led me to identify this hourly zone just here, drawing it from the low to the high of the candle, which created the imbalance just here. So going through that checklist, we have some liquidity resting below the area. it created imbalance, and it is also within the current leg of the trend. So what we do now is wait for price to come into this zone. Once price is in that zone, going back to the entry model, we first of all mark on the structure as we did on the higher time frame. So because this was a 1 hour point of interest, we go over to the 5 minute and we'll just play price a little bit. So I'm going to change the color of this just for some clarity, and we'll go ahead and mark on the 5 minute structure. So in this case, we've had this break just here. So in this case, this was technically a change of character, but there wasn't a valid point of interest. So I'm going to keep marking on the structure. So we've had another break just there. We had another break just here. So 5 minute is still bullish. And what we're simply waiting for price to do is break the most recent higher low. And price did that just there. So we've had a break of the higher low. That is our change of character on the 5 minute, just like that. Also notice as well that in this case we had a sweep of the top of the area of supply, so that would count as a liquidity sweep. And then what we do is wait for price to close below the structure. We have that. Did it create imbalance? Yes, it did. So what we want to do now is wait for a pullback into an area of supply, such as this one right here. This is a valid area of supply because it created imbalance. It broke structure to the left. It's within the current leg of the 5 minute trend. So we can set a limit on that whole zone. And once again, targeting a 1 to 3, which coincides nicely with this sort of low, and playing price. This ended up playing out very nicely. There we go, for 3% on that position. So those are the examples that I wanted to go through, and on to the last step now, which is arguably one of the most important. So it's risk management, and how do we, so for this trade, for example, how do we define how much we're going to risk on this particular trade? So how much are we willing to lose if this does in fact hit stop loss? And this is one of the things that I see most traders get wrong, is that they always have a different risk, oftentimes depending on how they're feeling about the trade. So for example, if they're more confident about the trade, they will enter with a higher risk. If they're less confident about the trade, they'll enter with a lower risk. And this is simply the wrong way to go about this, because if you ever study probability theory or any statistical analysis, you'll find out that if you change the risk on these sort of random outcomes, it skews the results, and it basically means that you have a lower expected profit or a negative expected profit if you skew it too much. So what we want to be doing is, no matter how we feel about a trade, so if we're really confident about it, if we're not so confident about it, we always want to be making sure that the risk is the same. So what I've recommended is, if you're on a personal account, 0.5% to 2% risk on the account. So if you have a £10,000 personal account, we're risking between £50 and £200 per trade. Again, this has to be the same every single trade, so we have to pick a value here and stick with it. And obviously this is going to vary depending on your risk tolerance and your personality. So pick a risk between 0.5 and 2%, ideally 0.5, 1 or 2, not some random number in between. And on prop firms, I would say maximum 1%, because on a prop firm account, you don't really need more than 1% risk to make a decent amount of money anyway. So for example, if we have a 100K prop firm account, we're going to be risking $1,000 for a 1% risk. This means that if this trade came up and it hit stop loss, we would lose $1,000 and nothing more, nothing less. If it hit the take profit, because it's a 1 to 3 risk to reward, that means we would make $3,000. And overall, if we have a 40% win rate, like I discussed, if we take 100 of these positions, we know that we will make an expected profit of $60,000. 40 of those will be wins, 60 will be losses, but the wins are 3 times bigger than the losses, hence the $60,000 gain. And I also get this question a lot, is what lot size do you use on the trade? And this is a very difficult question to answer because it's obviously going to vary trade to trade, since every trade will have a different stop loss size. But a way to easily get around this problem is to simply go onto my FX book position size calculator and calculate the correct lot size for the trade. So if we go over to that now, I'll show you exactly how to do this. So we type in my FX book position size calculator. This is a free software, and we click on the website. And what we can see here is we have the calculator. So we simply input the values. So here we have GBP USD. Account currency, let's say it's $100,000. So we put in $100,000. Risk ratio, this is where we go back to the predefined risk. So for this example, we wanted to risk 1%. So in this area, we input 1. The stop loss was, going back to GU, 16.7 pips. So we input that just here. This we can leave as 1 on every single trade, and then we just click calculate. As you can see, we're risking $1,000. Ignore the units. The size that we want is 5.99 lots, and that is the lot size that we put into TradingView, and that will give the correct lot size for a 1% risk on this trade. And like I mentioned, this would vary trade to trade depending on the stop loss size, because you're not always going to have a 16.7 pip stop. If it was 30, for example, we would just put 30 into the lot size calculator instead. Likewise with any other value. So that's risk management is really the simplest aspect of any strategy, but so many people get it wrong. And all it really takes is just to predefine the risk, and then every single trade, go to the MyFX book position size calculator and put in the correct values, and then it will just simply output that lot size for you. You then just put that into your MT4 account and place the trade. The only other thing that I want to mention about risk management is a break-even rule, which I haven't mentioned here, but we'll go through a break-even rule. So personally, I prefer set and forget approach. So once I'm in this trade, I never make the trades break even. I just let them run to stop loss or take profit. So the break even rule is simply no break even except for high impact news events. For example, NFP. So let's say we were in this trade and then NFP was coming out here. That means we would move the stop loss to break even, and this means that we cannot lose any money on this trade. Worst case scenario, it comes back up and it gets stopped out for break even, so we make 0 profit and 0 loss. That's why it's called break even. So we're basically risking 0 to make 3%. It's sort of like an arbitrage, except that the initial value was not 0, because we were risking money at the beginning, but that's besides the point. So a break-even rule is very simple: no break-even except for high-impact news events. So if a high-impact news event is coming out, we make the trade break-even. Otherwise, we simply let it run to the take profit or the stop loss. And one thing I want to say about this as well is this is probably one of the hardest parts about any given strategy, is letting the trade play out. So a lot of people, if they were in this trade and then it pulled back to their entry, they would start to get very fearful. They might close the trade early, only to then see it hit the take profit. And this, once again, is skewing your results negatively, because you're not allowing your strategy to play out and you're not allowing the winning trades to win, but you are allowing the losing trades to lose. For example, And this is very bad since, like I said, it's going to skew the expected profit negatively. So what we want to simply do is set and forget the trade. The best way that I find to do this is once we are in the trade, set an alert at the stop loss and at the take profit, and then step away from the charts. Don't even look at the charts until one of those alerts goes off. And that is simply everything you need to know about risk management. Very, very simple, but one of the crucial differentiators between profitable and unprofitable traders. And that is simply everything that goes into supply and demand trading. So if you guys find this video useful, or if you have any questions about this or how I personally trade it, make sure to leave them in the comment section below and I will answer them as soon as possible. If you guys also enjoyed the video, make sure to give it a like and also subscribe to the channel for more content like this, which I post on a weekly basis. But thank you guys for watching, and I will see you in next week's video.